Good morning, everybody. My name is Gilinski, as many of you know, and I'm the founder of the research service Brickell Analytics. Brickell Analytics is a two-tier research service where it's technical in nature, but our technical analysis divides in two parts: a discretionary analysis and a quantitative analysis. Our discretionary analysis is primarily predominated by a theory called the wave principle or the wave theory, where we use Elliott waves or waves to count markets, and then we generate price targets to approximate market tops and market bottoms. We have also developed what's called a velocity indicator, and it's a very valuable tool to approximate the top in the S&P 500 or the bottom in the S&P 500. I like to spend some time on this slide right now because the velocity or the speed on the S&P is very low. So the speed is at about 0 or 5, and our velocity indicator is hitting about 50, which means the market is extremely overbought. When the market is extremely overbought due to our velocity indicator being high or the speed being almost at 0, it means the market is very close to topping out. Now, there's limited upside in the market, and then what remains to be seen is when is the market going to go down. We have some sentiment indicators that also allow us to approximate the top in the market, and these indicators are signaling an overbought condition in markets. These are our quantitative models, or the performance of our quantitative models that we use to trade markets without any discretionary input. Our discretionary S&P model is up about 20% this year, and the cumulative performance is 167% since we started the model in 2010. We have an oil model, also quantitative model, that we started at the end of 2012. The model is up almost 700% since inception, and it's up 48% this year. Now, many of you assisted our presentation or attended our presentation back in March of this year, where we showed you some of our predictions that we made in 2010. We'll recap a few of those predictions. So last year in early February, we spotted what was called an ending diagonal pattern in the S&P, and we thought the S&P could go down to 2350. So we called for a very large drop when the S&P was at 3116. The S&P ended up dropping a little bit more, but it got to about the same target that we had. It got to 2200, and our forecast was 2350. And then when the market was at 2350, we called for a very significant rally to about 3500. Now, the rally since then has exceeded our expectations by 1,000 points, because the S&P right now is sitting at about 4,500. So the question for us now is, how much more upside is there in the market, and when is the market going to top, and when is the market going to go down? So today, it's important to highlight the forecast on Treasury yields. Unlike the S&P, the 10-year note yield has gone down since it reached a high of 178 basis points in March. Right now, the yield is about 120 basis points. If we look at this chart carefully, we can see that the 10-year note yield is missing one leg higher, or one rise, to complete a pattern. From an Elliott wave perspective, markets move in 5 waves up or 5 waves down. A 5-wave up movement is, once you can count a 5-wave up movement, you can count the termination of a pattern and a change in trend. So if we look at what yields have done since the March 2020 lows, they've gone up in 4 waves. So we have a wave 1 up, a 2 down, a 3 up, a 4 down, and we're still missing 1 leg higher in yields. So until the 10-year yield rises to about 2%, it's going to be very difficult to call for a top in the S&P 500. So it's more important right now to watch the 10-year yield over watching the S&P 500, because the S&P can, top at 4,500 or at 46 or at 47, but the 10-year yield has to get to 2%. So as long as the 10-year yield is not at 2%, the S&P 500 to a certain extent can do whatever it wants. And so here's our forecast on the S&P 500. We have we illustrated this last time. The S&P 500 has been forming a rising ending diagonal pattern. These patterns are terminal patterns. And the way you can spot this pattern is simply by drawing two lines that converge. So the pattern starts with a very wide or open base, and then it begins to narrow. And as the pattern narrows, you begin to spot what's called a triangle. And then triangles, as you know, have an endpoint, and that endpoint usually culminates in the end of a rising market. So I'm just gonna define what an ending diagonal pattern is by reading this slide. An ending diagonal chart pattern is a terminal technical formation that takes on a wedge shape within two converging lines. The pattern signals a reversal in trend. Diagonals are longer-term patterns that take more than 6 months to form. The rising wedge reversal pattern is formed by a set of converging trend lines that slant upward. So we first came on here in March and said that we had spotted this pattern and that it was going to take about an additional 6 months to form. And here we are 5 months later, and the 5 months that the pattern needed to form has panned out. In a bearish diagonal, when the top line or resistance line begins to flatten out, the pattern is signaling that upward momentum is waning and buyers are having trouble pushing prices much higher. So if we look at the formation in the S&P, you can see how since perhaps the May high, which is labeled with a number 3 on the pattern, the market went down. It had a small little drop, maybe 5-6% drop. It rallied up again, and then it dropped again by a little bit less. And now it's trying to, drop a little bit, but rise above 4,500. So this pattern is very, very near its conclusion. And so because there's a huge divergence between equities and yields, we don't want to come here and tell you, well, 4,500 is the top in the S&P 500 when the 10-year note yield is sitting at 120 basis points. So we would rather say or provide a range on where we think the S&P is going to top, contingent upon that yield rising above that March high, which is 178 basis points. So we're going to approximate a range and say, well, the S&P 500 can top between 4,500 and 5,000. In our last presentation, we got asked if there are other markets that we can follow that could also give us an idea on whether the market is closer to topping out. So today we're going to show 2 additional markets. First, equity market that has been diverging significantly from the S&P is the Russell 2000. The Russell 2000, similar to the note yield, made a high in March, and then it's been selling off since March. So it's spent the last 5 months in a trading range between 2,300 and 2,100. And as you can see in this chart, there's only 4 waves that the Russell has formed. You can see wave 1, wave 2, wave 3, and wave 4. So similar to the 10-year note yield, the Russell 500 is missing a 5th wave up. The 5th wave up in the Russell is a rally that exceeds the end of wave 3. Wave 3 was 2360, or the high was 2360, which ended on March 15. So it's important to watch the Russell because the Russell should rally or outperform the S&P before the S&P is ready to go down. Another interesting chart is the technical formation that Tesla has been forming since its all-time high in January of this year. Tesla hit a high of 900 in January of this year and then declined to about 540 hit in March. And then since then, the stock has not made much upside progress or much downside progress. It has been churning inside a range which has formed a diagonal or a triangle, in this case, a bullish diagonal or bullish triangle. So if Tesla can kind of bottom here between 650 and 550 and not go significantly below this, then Tesla would also be missing a wave 5 up, which would be the last leg of the bull market. And then Tesla needs to rally sharply to a level above 900. So it can be 950, 1,000, or 904. And then upon completion of that rally leg to above the high it reached in January, then Tesla is going to be ready to go down, and it would be a good indicator that equity markets are ready to top. And it would also signal how much liquidity is remaining in the markets, because if liquidity is coming in to buy Tesla at these very high valuations, to push it one last time to a level above the January high, that means there's enough liquidity to contain markets or to sustain markets from going lower. And then once the liquidity dries up in Tesla, then we know markets are much closer to an end. Of course, if Tesla cannot rally from here and it just declines below that low it hit in March, which is 540, then in this case, we're just going to be wrong, and the bear market is starting a lot sooner than we anticipated. Although we feel strongly that that would not be the case, because there's a triangle formation there as per this chart. And then lastly, last but not least, we'd like to address the Bitcoin market, which is one of the favorite markets of Flya and Flya members. They really like to know where Bitcoin is going. So from an Elliott wave perspective, Bitcoin topped at 65,000 in mid-April. The decline in Bitcoin since mid-April is a clear impulsive decline, which we call the start of a bear market, because we can count 5 waves down in Bitcoin from the 65,000 high to the 30,000 low it hit in June. So Bitcoin declined about 50%, and then it kind of formed a bottom around the 30,000 level. And then since then, it has tried to rally, or it has been rallying, and now it's sitting at about 45,000. So we think Bitcoin can rally to about maybe 55,000 or maybe 60,000. And it would be interesting to see if the top in Bitcoin was April of this year, because if it was, then Bitcoin should not, under any circumstance, rally above 65,000. And so if Bitcoin rallies to any level below 65,000, double tops, or kind of tops at what's in technical terms called a lower high, can kind of reverse and start to go lower, then we're going to get a very big signal, or a very big flashing red signal, that equity markets are also ready to go down, because liquidity is drying up, and Bitcoin has become an excellent market, engaging liquidity and how much money there is to go in the markets or out of the markets. And lastly, given the extreme overvaluation in Bitcoin, this is an extremely overvalued market. We believe that Bitcoin, if the S&P 500 can go down about 50% to the March lows of last year, then Bitcoin should go down to the lows it was oscillating at in 2018, which is about 3,000. So we would be looking at a potential 95% peak to trough decline in Bitcoin from the April 14, 65,000 highs to our 3,000 target. And with this, I'd like to end today's presentation and open it up to questions.
So you can put your questions into either the Q&A bar inside of the Zoom, or you can use the chat function, which is also inside of the Zoom toolbar. Any questions that you have, Isaac's able to do his best to answer them. Isaac, as we're waiting for some questions to come in, there's a couple of things that I wanted to go over with you today. We've known each other for a long time. We don't always agree with one another with regards to, you know, markets and your predictions, or the methods that you actually use to make predictions. But one thing that I will say to everyone on the call today is you're a purist. Can you explain to us why you choose to use Elliott wave and technical analysis, and why you don't use news or fundamentals to gauge the direction of asset prices?
So I believe this question has been answered before, and or has been asked before and answered before. So I'll be glad to go over it by simply going to my bio. So my background in both college and in my career has been in finance, and I studied, finance in college, and then I worked on Wall Street. And then once I came down to Miami, I got an MBA in finance and started a family office. And for the first 10 years of my investments career, finance career, I based all of my analysis, all of my forecasting, all of my investments on fundamentals. And everything I did was based on fundamental research. I mean, that's what I had learned in college, and that's what I had been practicing, what I started practicing on Wall Street, and what I started practicing when I started, my own family office and my own business. I radically changed my views after the financial crisis in 2009, because after 2009, I realized that the fundamentals, as markets went down, the fundamentals on the US economy, on the global economy, on the S&P 500 were getting worse and worse and worse, with really no end in sight. And so nowhere could I find someone that was telling me that the S&P 500, once it was around 700, it was going to go up. And in my curiosity, I started researching how I could turn bullish, and I came across this theory called the wave principle, or the wave theory. And by studying it and understanding it, I was able to see that markets were going to go higher, or they were going to turn. And so I became a student of Elliott wave theory, and then eventually I ended up forming my company. And then I had a structure where I was managing money through a fund of funds, and I was invested in other hedge funds that were all short biased and that were all using fundamental analysis at the top in 2007, but they refused to turn bullish at the bottom in 2009 or 2010 or 2011. And as they stayed bearish and I became more bullish, I realized that I could provide added value to hedge fund managers that I initially met as I was a client of theirs. And so I started advising hedge fund managers based on the process of technical analysis on how markets could go up. And then they ended up becoming the original clients of my business. And then through their, and through that relationship, I was able to start this business. And then the business became, more exciting and in a way larger than running a fund of funds. So I changed from being a fund of funds manager and sitting on the buy side to being a technical analyst and selling research using technical analysis on the sell side.
All right, so Isaac, thank you for explaining that. What I see from you over the past decade is you're really a purist. So people can really count on you doing technical analysis and not getting style drift into your analysis and seeing fundamentals show up in your predictions. So with that said, there's a bunch of questions that came in. Let's start out with the gentleman has a question about Bitcoin, and if you think there'll be any impact on companies that hold Bitcoin like Tesla, MicroStrategies, and any others that are holding Bitcoin. Do you think that these stocks are going to go down as a result of or possibly even up if it continues to go up? What do you think is going to happen?
So I think it's an excellent question. And given the fact that we have a Tesla chart in our presentation, it's going to give me the opportunity to answer this question in two parts. So part one is Bitcoin is the underlying. So it's no different than oil and an energy company, Bitcoin, and now companies that hold Bitcoin are, Bitcoin companies. So Bitcoin is your underlying, and then you have the companies that are correlated to Bitcoin because they hold Bitcoin. So if Bitcoin goes up, these companies that hold Bitcoin should go up. And similarly, if Bitcoin goes down, these companies that hold Bitcoin should go down. So if oil goes up, Exxon and Chevron go up, and Occidental Petroleum goes up. And if oil goes down, Exxon, Occidental, and Chevron go down. So the logic is identical. And so we're calling for a bounce in Bitcoin to about the 55,000 level, followed by a very significant decline. And now, interestingly enough, next to the Bitcoin chart is our Tesla chart. So we have, as Mike said, we're purely technical analysis, and so we don't try to come up with theories or cross our analysis between one chart and another using different types of theories. But if you look at this Tesla chart, we're calling for a significant rally in Tesla to 950, followed by a top, a reversal, and a very, very significant crash in Tesla going down to about 200. And so this Tesla chart is very similar to the Bitcoin chart. Rally up, followed by a crash. Rally up, followed by a crash. So you can, if you want to use fundamental analysis, attribute the rally in Tesla to a further rally in Bitcoin, and then you can also attribute the crash in Tesla followed by the crash in Bitcoin. You can do that because there is, that correlation on the charts, and both charts look very, very similar. So I think that as companies turn more bullish on Bitcoin and buy more Bitcoin, they are going to be more correlated or more susceptible to the moves in Bitcoin. So MicroStrategy that has a huge position in Bitcoin maybe ends up becoming a Bitcoin company instead of a strategy or tech company. So if Bitcoin goes down, then MicroStrategy is going to go down significantly. Does that answer the question?
Yeah, absolutely. So I'm going to take some of these questions, not necessarily in the order that they were coming in, but based on, what I think is important. There's a gentleman who's asking about, like, how has Elliott Wave performed under, real-time trading scenarios and back testing? Is it proven to work? Which I think, because that's the main gist of your research, wave theory, that if you could just talk about that for a second.
Yeah, so I mean, wave theory or the wave principle is generic, right? Nobody holds a patent on it, and you can take wave theory and use it however way you want, and you can use wave theory to always remain bearish. We have learned over the years that wave theory is very useful in both forecasting bull markets and bear markets. And we've, have had our set of, very valuable predictions that we have made over the years. Of course, like everybody else, we're a forecasting business, so we've gotten a lot of things wrong. But over the years, we've become better and better at removing any type of bias that comes with, technical analysis, and at forecasting both market tops and market bottoms. On our website, on our website, brickellanalytics.com, there's a tab called Market Calls, and there you can, view some of the calls we've made over the years, both bullish and bearish on all the different types of markets, forecasting turns using Elliott Wave. But I would like to zero in on two important calls we made last year using Elliott Wave, and one was a bearish call, the other one was a bullish call. Again, we were, bearish at the highs in February of 2020, and we were calling for a steep drop. And then once the drop happened, we turned around and we became bullish, and we called for a rally. So if you are flexible in your thought process and you understand that markets can go both up and down, then Elliott wave is a very useful tool in anticipating, market turns or market reversals in both directions.
Isaac, let's talk about the dollar. And the reason I'm choosing this one is a lot of the follow-up questions are going to be about things that are impacted by the dollar. What are some of the predictions on the US dollar strength, weakness, any significant insight into any of the pairs that you can, help to showcase?
So the pair that we like to follow the most, and that has a very clear pattern, and unfortunately, we didn't bring it today, or we didn't put it in our presentation because we did not think it was going to be a topic of interest, is the dollar against the yen. The dollar against the yen has been forming a very interesting triangular pattern since the high in 2015. So the dollar yen hit a high of about 125 in June of 2015. And then the cross pair declined significantly to about 25% to the 99 level or 100 level reached in 2016. And then since January, February of 2016, over the last 5 years, the dollar yen has really not gone up or gone down. But what it has done in Elliott wave terms, it has formed a very, very nice triangular pattern that seems to be converging. So if this 5-year long or 6-year long triangular pattern in the dollar yen is correct, then it means that the dollar yen is going to stage a significant rally and go up above the highs that it reached in 2015, which was 125. So if the dollar yen goes up, that means that US interest rates are going to go up. So if we have a 2% forecast on the 10-year yield, and the 10-year yield is at 130 basis points, and we think that the dollar yen is going higher from current levels, I think today it's at about 109. So it has another 15% upside. Then that means we are primarily bullish on the dollar. And so if you're bullish on the dollar, then you have to put the dollar view into perspective on whether you're bullish on the dollar because you're in a bear market, or you're bullish on the dollar because you're in a bull market. When you're in a bull market, usually the dollar could rally against the yen, but it can sell off against other currencies, whether it's the Australian dollar, the Canadian dollar, or the euro. Now, if you're bullish in the dollar on the dollar in a bear market, then the dollar rallies against every currency except the yen. And in this case, the dollar may rally against the yen, and interest rates may go up and equities may go down. So to simplify the question, we are not really focused on the dollar against any other currency except for the dollar yen. And we think the dollar yen should strengthen, and we think the dollar has a strengthening a path from here, given that interest rates are going to go higher. And then we'd like to evaluate the dollar against every other currency once the 10-year yield is at 2%. And if and when the dollar yen gets above 125.
All right. Isaac, there's a gentleman who's asking for you to summarize your conclusions. And he's asking for, 10 years going to 2%, and the S&P 500 is going to rally to 5,000 before a steep decline. So he's asking for a summary of your conclusions.
Well, I mean, you already summarized it, right? 10-year yield to 2%, S&P 500 to a topping range between 4,500 and 5,000. And I would like to repeat what I said at the beginning of the call, right? More important than coming in and saying, hey, the S&P is going to top at 46 or 47 or 4,800 is this specific pattern on the 10-year yield. Yields have to go up, and they have to go up on the 10-year yield. We have to get above that March 30 high of 178 basis points. And that rally to 178 basis points in the 10-year yield is going to be very positive for stocks that are correlated to yields or that are cyclical in nature. So they could be financial stocks or airlines or aircraft manufacturers or manufacturers of equipment. So JP Morgan, Wells Fargo, Caterpillar, Boeing, American Airlines, all these stocks that are tied to, you know, a reopening of the economy, to an economy that's expanding and growing, are stocks that are going to make the S&P 500 go up. On the other hand, if interest rates go up, we've seen that this has put a ceiling on the big cap technology companies like Facebook, like Apple, like Amazon. And so what we have to see right now, and that's why making a precise target on the S&P is difficult, is where we're going to start to see rotation out of these technology stocks that are, you know, less, that perform better in a low interest rate environment, and we're going to see buying in cyclical stocks that are more sensitive to rising interest rates. And if there's more buying in cyclicals than there is selling in big cap technology, then in the margin, the S&P should go up about 4,500, 4,600, 4,700. Conversely, if the selling in technology outweighs the buying in these cyclical stocks, then the S&P will remain closer to 4,500. So I think right now we're at a situation where yields are going to dominate the direction or the price target of the S&P 500, because we're going to see what's rotation. And then again, I would watch the Russell 2000, because the Russell, unlike the S&P, still needs to rally above its prior record high. And so we may see an outperformance of the Russell relative to the S&P, because you're going to get a move from out of big cap stocks to small cap stocks.
All right. Are we ready to move on to the next question? Isaac?
I'm ready. Yeah, I hope that answered that prior question.
All right. So wave analysis for oil.
Yes, I mean, I think what we should do the next time I'm going to present is maybe ask our participants to send us an email on what markets we'd like to look at, so that we can come with a chart. So again, oil is another market we follow that we didn't bring the chart today, which makes it a little bit more difficult to explain. But in short, energy is a very big component of the Russell 2000, and energy companies are a very big component of the Russell 2000. So just like we think the Russell 2000 needs to rally and yields need to go up, we still think oil is missing a leg higher above its prior high, which I don't remember right now whether it's 77 or 76. So right now oil's around $65, $66 a barrel in crude. And we don't think this is the start of a bear market in oil. We think oil should bottom here, reverse, and rally higher before we're ready to start a bear market. So for practical purposes, given the fact that we didn't bring a chart, I would say that probably $80 is an appropriate price target for oil before we can, you know, say, hey, oil's going to turn bearish and it's going to go down significantly. I'm done with this question.
All right. What are your thoughts on precious metals?
We didn't bring a precious metals chart. We got asked that question 6 months ago. What was our thought on gold and the gold miners? And we said, hey, you know, we're not bullish and we're not bearish, we're neutral. And I kind of think that that was the right response, because these precious metals have been stuck in a trading range. So I don't have high conviction on precious metals either way, primarily because we have a very bullish view on the dollar yen. And we think the dollar yen is going to go up, and gold is very sensitive to the yen, because when the dollar yen goes up, which means the yen devalues, usually gold goes down or sells off. But gold has been underperforming the S&P 500. So, I mean, it could kind of bottom here, but it can face It's going to face headwinds because you're going to get a rally in the dollar yen. So I'm not particularly excited about the precious metals right now either way. That could change if we can sit and look at the charts and zero in and see if there's some sort of rally leg that's imminent. But for now, we're gonna stay on the sidelines in regards to precious metals. We're not going to be bullish or bearish, which is pretty much exactly what we said in our past presentation in March. I'm done with this question.
All right. So Brad is asking, I have also noticed the weakness in the Russell 2000 compared to the Dow or S&P, as it has formed a rounded top that started in February. Before one last 5 wave to 2,400, as you mentioned, can you first see a drop to 2050 support level, which would be about a 5% correction from current levels? Even for the stronger indexes, market breadth has been weak, as S&P and QQQ have shown RSI divergence for the past few weeks.
So, I mean, I like to answer Brad's question in 2 parts. Part 1 is the rounded top comment that Brad made. So if the Russell 2000 is forming a rounded top, that means the Russell 2000 topped at 2360 in March, and it's not going to go higher, and it's not going to drop 5%. It's going to actually drop 50% and go down to 1200, right? And if that's the case, then the bear market is imminent. It's going to happen right now, right? So I would associate rounded tops with tops that are just significant and that are terminal, right? So if that's the case, and you can make a case for a rounded top here, because if you look at the number 3 on this chart, that's the high in the Russell, and for the last, since March, for the last 5 months, the Russell hasn't really gone above that level, and it can turn and start to decline and just go to 1200, right? That would be a rounded top pattern. The alternative is the Russell, attempts to go lower, but does not decline below 2100 or 2050 for that matter. It's the same, support level. And it continues to tell us that the decline since the March highs is actually a triangular formation or a corrective formation. And so it should not get below 2050 or 2100. It should bottom there, and then it should rally one last time. And because of our forecast in the S&P, where we think it may just go a little bit higher, and because we're bullish on Treasury yields, and because we don't think equities are just ready to top right now, we think the Russell 2000 will most probably hold that 2050 or 2100 level, right? Churn and then reverse and rally to a level above the March high, which means there's no rounded top, but there's a triangular formation since the highs, and it needs one more rally leg before the bear market can start, or it's ready to go down big. And then after that, you'll be able to take, if you look in this chart, you take the end of the wave 3 up and you align it with the end of the 5 up, and you can actually create a rounded top that started in October. It rises, then the top is the connection between the 3 and the 5, and then the market begins to roll over in your A wave of the bear market, which for the Russell we have a target of about 1200. So I don't think we're there yet, and I actually would prefer, or would think based on today's forecast, that the Russell should not decline below 2050. If it does, it's going to be worrisome, and it's going to force us to become bearish prematurely, or sooner than we're anticipated in this presentation. I'm done with this question.
All right, thank you, Isaac. Brad, hope that answer addresses your question fully. That was a great question. There's a lot of great questions coming. And Isaac, have you been doing any analysis on VIX If so, what's your view?
Yes, the VIX is again correlated to the S&P, right? And ironically, it's been very difficult for the VIX to get below 15, and every time it gets down to 15, it goes up to 20. In a perfect world, ideally, is you get the VIX to break below 15 and go down to 14, 13, 12, and it just stays there for a few months, allowing the market to form that infamous rounded top pattern before markets are going to go roll over. So the length of time the S&P is going to take in topping, right, is what's going to determine where the VIX bottoms. So if the S&P rallies very quickly to 45, 46, or 4,700, and then quickly reverses, and we're in for a bear market, I don't foresee the VIX going below 14 or 15. But if, on the other hand, the S&P gets to its ultimate upside target, which could be anywhere between 4,500 and 5,000, and then it sticks to that target and it just stays there without much upside progress or downside progress, forming a so-called rounded top, then you're going to get the VIX is going to get crushed. The market is going to become highly complacent. Everybody's going to be very bullish. And then that's going to give you your perfect top. It's going to give you your perfect signal to literally sell equities and, you know, either go short or go to cash. So again, ideally, we like the VIX to break below 15 and then settle between 13 and 10 for a few months, allowing this market to top. And then let me just say that the bottom in the VIX is going to mark the time it takes for the S&P to top. So if the VIX can break below 15 and get down to anywhere between 13, 12, 11, 10, and just sit there for a little bit, you know, the S&P is going to take the remainder of 2021 to top. And then we're going to probably see the ultimate high in the first quarter of 2022 before it rolls over. Conversely, if, you know, S&P rallies very quickly to the top and then just reverses and starts going lower, and the VIX can't break the support level of 15, we're going to get a bear market that starts in the fourth quarter. So I would watch the VIX, and I would hope that, you know, for the purpose of, you know, having more time, that it actually goes down to a low level and stays there for a little bit and allows this market top to last, you know, a few months or maybe half a year before we go down in earnest.
All right. So we have a question from Ken. It says, concerning your earlier slide illustrating the Brickell Speedometer, what did you say the indicators, or it says, what did you say the indicators were at with regards to this Brickell Speedometer? Like, I guess, like, what is it? What's the speedometer saying right now? Okay, so the speedometer measures the speed of the S&P. So if you picture a car, when a car is going very slowly, it can't, you know, really crash. And then when the car goes very fast, it crashes. So what we did is we created a speedometer where a slow car, or a car that's literally parked, equals to a very high market. And a car that's going super fast, you know, at a speed that exceeds 80 miles an hour, it's susceptible to crashing, right? So here we take this analogy of a car that goes either very slowly or very fast, and we apply it to the S&P 500. And right now, the speed of the S&P is it's going at about 5 miles an hour, which in terms of our velocity indicator, it's sitting or hovering around 50. So this is telling you that this market is very overbought, right? Extremely overbought. And so we're very close to a top. That said, before the market can finish topping and even go down, you need the speed of the S&P to actually go up, which means, you know, you're driving in the direction of a crash. So you need the speedometer to kind of mark you a top, whether it's 50 or 54, and then start to reverse and go down to, you know, the single digits before the market can get ready to crash.
And then as it does, as the market slows down, and we discussed this earlier in terms of rotation, you can get rotation from one sector of the market to another. And the rotation on the surface could be bullish for equity. So you could still get a little bit more upside on the S&P 500, right? While your velocity indicator goes down and the speed of the S&P goes up before the market tops and it's ready to crash. So not to overcomplicate the answer, but timing wise, let's say we're in the 8th inning, maybe top of the 8th inning or bottom of the 8th inning, because of this, velocity indicator being very high, we're very close. We could be, between 1 month away to maybe 4 or 5 months away from a top. And then we like to see the velocity indicator reverse from 50 to lower to give us confidence that the market is beginning to roll over, and then eventually the speed or of the decline will go from very slow to very fast, which is eventually what culminates in a market crash.
All right. Next question. We're going to go to the 10-year Treasury. There's a gentleman that's been very patient. I'm picking up the question out of the chat. So, Kevin, thank you for the question. He's asking, why does the 10-year U.S. Treasury yield have to go higher?
I wish I had an answer for you, Kevin, but we're technical analysts, so we have no idea, right? I mean, the idea, which is not part of our analysis, means, that the Delta variant fizzles out, governments become more loose, and then the reopening trade, has one leg higher, and that will be bullish for the U.S. economy, which means markets are going to go higher and yields are going to go higher. But the truth is, I don't know what the catalyst is. I just look at the count in the chart, and it's clear that if you're an Elliott wave practitioner, you practice Elliott waves, and you want to call a decline in yields, you first need to count 5 waves up in Treasury yields. So you can see by the numbers in parentheses that Treasury yields, or the 10-year yield, since the low of last year, has only formed 4 waves. Wave 1 up, wave 2 down, wave 3 up, wave 4 down, and it's missing wave 5 up. And wave 5 up ends above the start of wave 4 down, or at the end of wave 3 up, which in this case is the high that it reached in March 30th of this year, which is 138 basis points. And so that's where we get the 2% target. We just think the yields has to go up to 2% so that we can get a completed Elliott wave pattern in the 10-year yield since the low of last year. And that's what we get, where we come up with this forecast. As yields begin to rise, you'll realize that the market that does a lot of ad hoc analysis will come up with various different explanations on why yields are going higher. And the best one that I can think of, again, is, the Delta variant fizzles out, people are, less scared, people start going out, traveling again, airline stocks go higher, construction companies go higher, banks start to go higher, and then that will be very bullish for interest rates or vice versa, and that's why the yield goes up to 2%. Done.
All right, Isaac. So there's a gentleman that's asking if you sell a subscription.
Yes, we're a subscription-based service, and if you can email Mike, we'll email you the links on how to subscribe to our service. We have a monthly subscription and an annual subscription for a discount.
I believe it's the same gentleman who's asking if the presentation that you went through is going to be available to the participants today.
I think you can email us individually, and we'll email you a copy of the presentation.
Okay. Matt is asking about Fibonacci retracements. Do you use those as part of your subscription service, the analysis? And if not, do you have any opinions on Fibonacci?
Fibonacci is retracements and extensions, if I may add. Retracements is half of it. Every target on every chart on here, so the targets are marked by red, right? So we do Elliott waves, which is the labeling in black, and then we do Fibonacci retracements and extensions, which are labeled in red. So every number on every chart on here is a Fibonacci either extension or retracement. So we do Elliott waves, and then once we count the waves, we use the Fibonacci method to estimate our price targets both up and down. So it's a combination, and I believe in this chart here, where we say wave theory and price theory, our wave theory is Elliott waves, and our price theory is made of Fibonacci retracements and extensions. So it's a critical tool of our service, and without the Fibonacci retracements and extensions, we cannot generate any price targets, which means, you know, we cannot forecast. So it's the core of our business. So I appreciate you asking that question because it's very important. I can't hear you.
Here we go. Sorry about that. There's a gentleman that's asking, he's asking a question of how he can use the information today to manage his portfolio of 25, 30 stocks, along with, you know, spiders. I guess he has some S&P index. How can he use the info today to manage his portfolio better? And like, are you telling him to sell his equities and wait for the bottom, or to hold his positions? And so I'm gonna just turn that question over to you.
So I like to always answer this question to new subscribers or people who are getting to know us, in the fact that, you know, anybody who's in the research business or the forecasting business takes pride in getting things right. Well, we're the opposite. We actually like to get things wrong. Why? Because the more wrong we are, the more right we're going to eventually be. And so if you're new to our service, you want to start using our service and see if we can get things wrong. And as we get things wrong, that's going to give you an idea on how closer we are to being right. So for example, we came here in March of this year and we said, look, you know, and I think the S&P was at about 3,800. And we said, look, you know, the S&P is going to top between 4,000 and 4,400. Well, lo and behold, the S&P is already about 4,400. So we got that upside target on the S&P wrong, because it's above 4,400, which, if you're watching us, it's actually a very good thing. Why? Because we have not changed our stance on the S&P and now turned bullish. We continue to tell you, hey, the S&P is going to top, and the target, the upside target, is 4,500 to 5,000. And then our research becomes very valuable when markets, you've been watching us for a few months, we're getting it, we got it wrong, and then every day that goes by, we get it less wrong and less wrong and less wrong, and we're getting closer and closer to getting it right. Because then you're going to get an amazing signal, which is a great timing tool for you to either buy or sell out of your positions. Because let's say we're 100% right and the S&P tops at 4,500 and then the market crashes to 2,200, then our service has provided very little value to you, because it hasn't given you a chance to sell out of your positions before the market drops and use our service effectively. Of course, it may be helpful once we're down at 2,200 and we decide to turn bullish, but you really want to reap the benefits of this, you know, not when we're right, but when we're wrong, and we're wrong for a long period of time. Because there's one thing that we do, is the more wrong we are in a forecast, the more conviction we have that our forecast will eventually be right. And so it's very valuable for our subscribers that we have very high conviction, and most of the time we're early. And being early is a good thing, because it allows our subscribers, who are the traders, we're the researchers, you guys are the traders, to get out of your positions at the right time, eventually, when the markets prove us right instead of being wrong. Done with that question.
Okay. There's a bunch of questions left. Just trying to All right, so I'm actually going to go to somebody who's been very patient. Do you think that Coinbase will drop as Bitcoin will? And then he's got a statement that says, don't you think that a crash in Bitcoin will mean a spike in the number of transactions benefiting Coinbase?
Again, the Coinbase Bitcoin correlation is the same thing as the Tesla Bitcoin correlation, right? Well, Coinbase is a publicly traded stock. It just IPO'd and it's correlated to Bitcoin. And as Bitcoin goes up, Coinbase goes down, period. And yes, number of transactions can spike as people begin to panic and sell Bitcoin. But remember, Coinbase is an equity, and the equity of Bitcoin of Coinbase is linked to the valuations of the S&P. And so the value of Coinbase is very high relative to the S&P. So if the S&P goes down, Coinbase or the value of Coinbase stock is going to go down.
All right. Edgar, thank you for that question. I want to move along. Vishal has a question on any thoughts on market returns versus money supply. And then he has a statement calibrated for M2. The market looks like it has not moved much the past 2 decades.
So I think that M3 is more valuable than M2 because M3 covers all cash in U.S. banks, all of it. So it's a wider measure of M2. And money supply is it's the most lagging of lagging indicators, right? Because by the time you count or the Fed provides all the data on how much cash there is in banks, and how much total cash there is, markets are usually going in the opposite direction. So the money supply measure should expand as the S&P rallies. Then the S&P tops begins to decline, and money supply will still continue to expand until markets are crashing. People begin to panic. They take money out of banks, and then money supply goes down. And then vice versa. If you studied money supply in the 2008 to 2009 financial crisis, it was very interesting because the S&P bottomed in 2009, and M3 went all the way down into 2010. After the S&P had already gone up 100%, M3 was still going down. And then finally M3 turned and then started to go up and increase. But the S&P was already in an uptrend. So I think it's a very, very, big lagging indicator. It's one of the laggingest of all indicators in comparison to the direction of the S&P 500.
All right. Isaac, there's one last question that I want to get to. There's a bunch of unanswered questions that you have before we end this today. This is from Brad, who asked a good question earlier. Correlations between global equity markets tend to go to 1 for any significant corrections. Do you have current Brickell Speedometer readings for the major EU markets, Germany, France? Regarding the charts, they look very similar to the Dow and S&P right now.
So we don't need a speedometer for Europe or any other market because the S&P is the single most important stock market, equity market, or market in the world, right? As it says, as the US sneezes, the world catches a cold. And the sneezing in the US doesn't really happen with economic indicators or inflation measures. It really happens with the S&P 500. So if the S&P 500 goes down and crashes, everything else goes down, and then vice versa. It's a very big, large index that has, a market cap of over $30 trillion. And the wealth effect generated by the S&P is so significant that it ripples across the world. So we like to, look at the German DAX, and the correlation between the German DAX and the S&P 500 is literally 1. I mean, these two indices are nearly identical. So by that measure, if the speedometer on the S&P, if the speed on the S&P is low, if the velocity is very high on the S&P, it's the same applicable for Germany. Germany is getting very close to a top. Germany is forming the exact same ending diagonal pattern as the S&P. And the upside target we have for the DAX is about 17,000. And once the DAX tops around 17,000, which should correlate to anywhere between 4,500 and 5,000 in the S&P, the DAX should drop about 50% down to the March lows of 2020, which I believe the level is about 8,500. So if because Europe is so correlated to the US, we don't need to have multiple speedometers. We just have one, which is the speedometer of the most important market.
All right, Isaac, that concludes our session today. I want to thank you for coming back on and taking your time to answer the questions that you know, the audience today threw at you. We appreciate you coming back and sharing the information with us. I'll be making a recording of today's presentation available for those of you that want to look at it. It's on our site, events.flya.org. It'll be available tomorrow. We usually need about 24 hours. We'll also be sending out an email, you know, with a link to today's presentation. Isaac, how can people get in touch with you if they want to subscribe to your service?
So I think you can send an email to outreach@brickellanalytics.com. Repeat, outreach@brickellanalytics.com, and we will reply to you. Alternatively, you guys can talk to Mike. So whatever is easiest. Outreach@brickellanalytics.com or Mike. And then Mike, I see that there's, you know, maybe 12 unanswered questions. If we can maybe save them and we can use them for a later date or to address a presentation at a later date.
Absolutely. All right, Isaac, thank you very much for coming in today.
Thank you.
That concludes our session.
Thanks.